Now, one question that I wanted to ask you, especially since this is more your expertise, is how should young investors maybe different than their amounts of alternatives in their portfolio than, let's say, an older investor that's near retirement?
So it's really interesting because unlike equity and fixed income, I actually don't think you make an adjustment on your allocation to alternatives, no matter what your age is. The
Okay.
benefits are there, and it actually complements whatever you're doing in your traditional allocations. So 20% is an absolute minimum. Maximum allocation of about 30%. Anything more than that, it's not offering the diversification benefits, and it actually could start to chip away at your returns because the alternative portfolio allows you to take risk in your other portfolios. So you can have riskier, higher opportunity for excess return options in your equities because this alternative portfolio is really helping to mitigate volatility and diversify away that risk from the overall portfolio. So, in my opinion, everybody should have at least 20%.
Love it. Let's get into the side of real estate. Of course, it
Mm-hmm.
seems like it just hangs in there. It's not coming down. Of course, the low supply might be a help to this. But do you expect to see maybe the housing prices falling or getting into some kind of housing recession?
It's interesting because I think it's a good point. There's very little supply. We don't have nearly enough supply to meet demand. And as long as that is the case, it's going to be really hard to have any sort of major downturn in the housing market because, quite frankly, most people who own homes right now have locked in very low mortgage rates. They're not in any big rush to sell because they'll have to buy at a higher rate. So the majority of people that are selling are either because they have to, because of a job relocation, because they're downsizing, because there's been a death in the family, a number of different reasons, but not opportunistically. So then it comes to, where's increasing supply? How are the home builders? Are they adding to supply? Is there new builds coming on? And we're not seeing that at all. In fact, I would say that most home builders have PTSD from the financial crisis, and they are not inclined to add any more to the supply unless they know that they have somebody on the other side that's ready to buy it. So there's not a lot of building going on. That has been a persistent trend. There's not a lot of incentives for home builders to build new homes.
Yeah.
And so this problem we have is going to be, long term. I don't know what the solution is, but I can tell you that, existing home sales, not a lot of incentive to sell because you're locked into ridiculously low mortgage rates. And, there's always going to be demand for housing. So as long as this weird relationship persists, I can't see anything that would cause a major downturn in home prices at all.
Definitely. Now let's get into a little bit more of what about the Fed and the market. I heard you recently call it a game of chicken, whether the Fed would cut this year or not. Do we finally get that famous pivot this year? What
I
do you
don't
think?
think we do. No, I don't.
Nope.
The economic data is too strong. As long as the employment market is as strong as it is, and I see no signs of that changing, there is a lack of labor participation. We've seen a lot of people move out of the labor markets. A lot of people retired. A lot of people starting their own businesses. There's just low labor force participation. The number of people in the labor force has declined significantly. And as long as that's the case, you're going to have more jobs than people who need them. And so you'll have strength in the job market. We had a blockbuster employment report recently. Nobody saw it coming, but it just talks about this stickiness in the labor market, which is going to cause wages to go up, which is going to keep inflation high, which means the Fed's going to have to stay hawkish. You have China reopening. That is inflationary. There's nothing to give me any reason to believe that short of an unexpected geopolitical event, that the economy is going to turn to a point where the Fed feels it necessary to cut rates at all. I can see them pausing if they start to see some weakness, but there's no scenario short of an unexpected geopolitical event I can see the Fed cutting rates in 2023.
Yeah, I think we got a little hint on that from Jerome, right? I mean, he kind
Mm-hmm.
of told us in that last talk that definitely he didn't see the inflation getting to 2%. this year. If anything, next year. So I don't see them cutting. And they keep saying, changing up a little bit of that language. One of the recent ones, of course, it was the sustained at 2%. So we'll see if we get to sustained 2%,
Well,
right?
they've been saying sustained 2%, and the market just hasn't listened. That's not new language. They've been saying sustained, maybe not sustained 2%, but they've said sustained inflation, sustained at a lower level. And we're not seeing that. And now we have other inflationary pressures. The Atlanta Fed just put out a report saying that wage growth is up 6%. Like, that is not a good sign for inflation. China reopening is not a good sign for inflation. Russia reducing the output of oil, not good for inflation. All of these things are not going to be helpful. And the Fed can only do so much, but what they won't be doing is cutting rates, in my opinion, anytime soon. Like I said, short of some unexpected black swan geopolitical event, I cannot foresee any situation where they would have any reason to cut rates.
Interesting there. And of course, we've been seeing, at least we saw the Russia cut this morning. Do you see any expectation of inflation coming back in, maybe commodities, into the oil game? It seems like, we can't get into the 60s, definitely with crude. It just seems to bottom out there around the 70s right now. And then you got Goldman Sachs calling 200 by the end of the year. Where do you see it?
It's crazy. I actually do see oil prices going up. You're seeing it in the market today. Crude prices are moving to the upside after seeing some weakness for the last couple of weeks. I think that's going to continue. And it's so funny to me when you're like oil at 100, like during like the financial crisis, oil was like 120. So we're still well below like what highs we've seen in the past. And that just shows this shift. We're moving away from oil dependence, and you're seeing some shift into other types of ways in which we can power, vehicles and the like. And even though it's only a small shift, it is making a difference just in overall demand. But the truth of the matter is we still have a real need for these things. They are going to have to pick up as much as we can in supply somehow. And, oil prices will kind of react to that. But I do see oil prices going up, in the next few months, maybe not to $100. I don't know if I see that, but definitely see oil prices rising.
Yeah, it definitely could be signs of concerns for inflation coming forward. Now, I know that you've been looking at some tech names, right? And seeing some opportunities out there. Let's talk a little bit about that. We've definitely gotten a recent rally in tech, and you can see it definitely when you're looking at the sectors relative in like the year, right? And you can see the transition. It went to technology, consumer cyclical, those high beta names and the tech names. What do you see for opportunities out there?
So I think tech had a bit of like a technical correction that was going on. I heard somebody refer to it as algorithmic short covering. I think there's some truth to that. I think that's why you're starting to see some weakness there today. But at the end of the day, while I don't necessarily see growth outperforming value going forward, I do think that there is some opportunity in tech because the long-term viewpoint for a lot of technology stocks is incredibly bullish. There's a lot of tailwind to their businesses. As we move more to AI, as we move more to EV, these types of technologies and their inputs are going to be increasingly important. So long-term tailwinds, short-term headwinds. So I'm taking this opportunity to look at names that I have always wanted to buy, but didn't because they were expensive. So NVIDIA is a name that I've been following essentially my entire career. It's had a bit of a bounce. I did buy some personally before the bounce. So I feel like I lucked out a little bit there, but that's a name that on some weakness, I would continue to add to that position. Apple is a name that under 130 again, I would absolutely be a buyer because again, long-term tailwinds, short-term headwinds. There's some concern over, China and how that impacts Apple. But those are two names I really like. Marvell Technologies is another one. It's in the chip space. Great long-term, view there. Short-term headwinds. They've had problems with inventory and meeting demand. But I guess if I'm going to buy a stock, if having the problem of having too much demand and not enough supply is a problem, that's a good problem in my opinion. So I'll take advantage of that every day of the week.
Definitely, like I've been trying to say with some of these, especially for investors out there, we might have to look at the short-term pain for the long-term gain, right? We'll see
Hmm.
what happens there. Let's take a look at the last question that I want to talk about, which is really kind of more of an interesting question. I wanted to take a look in how you look into alternatives, maybe investing into collectibles. Right.
Yeah.
I mean, I don't know if you've heard of opportunities like Rally out there. That's a platform for collectible assets. I've been taking a look at things like this, just different opportunities, right? We have different opportunities right now, especially than the market with
Hmm.
interest rates rising. What do you see out there?
So it's really interesting with collectibles. I always work with folks to figure out what they're passionate about because that really like speaks to like personal passion, right? So if
Hmm.
you're okay with illiquidity, because collectibles are incredibly illiquid, so it's got to be more of a passion play because most people are not going to be okay with the type of illiquidity you have in these collectible markets. Now, I know there's talk about tokenization. I know there's new and interesting ways, but at the end of the day, your ability to generate any sort of return on something you invest in really is based on whether or not there's a buyer when you're ready to sell. So regardless of the form, it's is there a buyer? And collectibles tend to be more difficult to match buyers and sellers, and so it's much harder to sell like on a whim. But I think collectibles can be quite interesting, particularly as finding things that people are passionate about, because the long-term opportunity, the long-term chance for excess returns is quite good because there's scarcity, and things tend to gain in value when there's a scarcity aspect to it. So in the past, I've looked at things like music rights, wine, cars. One of my favorite funds I ever kind of worked on was a violin collectible fund. These things exist, and there are more and more ways that it's becoming easier to access these things. But I can't stress enough, you got to be okay with illiquidity. No matter what form these come in, it's always going to be a less liquid investment. And so if you are one of those people that might panic and want to get your money out right away, you have to know that these are not the type of investment you'll be able to do that with.
Love it. Hey, at the end of the day, we all need exposures, different ways to diversify and
And
give ourselves a little bit of return, right? I
I
mean,
always say that there's alpha in illiquidity. So if you're
mhm.
willing to do it, there's a real opportunity there.
Love it. Well, definitely, we touched all different parts today, from the 60/40 portfolio to the Fed and some tech opportunities. You guys check them out and definitely keep up with Shana Sissel. You guys can follow her on Twitter. Definitely a great follow, and we'll have you back. Appreciate you coming
Awesome.
on today.
Thanks for
All
having me
right.
again.
Like awesome. Like always, team, let's get back to the